This is a discussion of the things that have come about from the passage of a variety of federal laws that are intended to provide relief for taxpayers during the COVID-19 crisis. And yesterday we did a program talking about the individual impact. Today we're going to do a program talking about the business impact. And I do want to say, by way of disclaimer, that this information is current as far as I know at the time it was put together, but this is an extremely fluid situation. There are new bits of guidance being provided from the IRS to both taxpayers and other accounting professionals that can change a situation. And as you'll see when we go through some of the slides, there are even some issues that we know about ahead of time that we don't have an answer for yet. And so we'll have to rely upon those things. The difficulty for any business owner is that you're also in a fluid situation. Your business may or may not be shut down during the current period. Your business may be greatly reduced during this period, or you might be a business that because of the kinds of things that you do, you're actually seeing an increase in the business that you're doing. And so for all of those reasons, the accounting aspects of what's going on in your business are still very important, and you need to keep track of those things so that you can be sure that when the time comes to do your taxes, you've got the information available to you to do them properly, as I said, when the time comes. So some of the things we'll talk about here this morning will also be kind of a cautionary tale to let you know that even if we aren't sure how this is going to turn out, here's some of the things you want to watch for so that you won't be caught up short when the time comes for these things to be important by the filing of your 2020 taxes. Now, if I can get the, I'm assuming everybody is seeing the screen that says business taxes and COVID-19. If anybody is not, would you send me a chat and let me know that you're not? And hearing no objections, then we'll go ahead and go on. One of the first things that the laws did, or that happened after the COVID-19 problem started, at the encouragement of the Secretary of the Treasury, the IRS used its administrative authority to extend the deadlines for both filing and paying taxes for 2020, or for 2019, excuse me. And it was done in 2 steps, which was kind of unfortunate. In fact, there's actually been 3 steps as it's finally turned out, because originally all they did was provide an extension of the time to pay, but not an extension of the time to file. And then they followed up with putting them both together. And then finally they came up with the estimated tax periods. You don't have to do anything to take advantage of these extensions, but know that July 15th is now the date when all tax returns that would have been due on April 15th are now due. It's also the date at which all payments that were due on April 15th are due. And then as an added plus, if you have an estimated tax payment that's due on June 15th, that is now extended to July 15th. So that kind of puts everything all in one package so that we have a better idea of what we need to be doing and what we have to worry about. I will mention that if you still have either as a, if you still have as a business a problem getting done by July 15th for your filing, you can still get an extension, but it only goes out until September 15th for a business return. Or if you're filing an individual return, which means a Schedule C, then October 15th is the final date that you have. And I realize looking at my slide here that I didn't update it from the personal tax return issue. remainder of the estimates, if you're paying any estimates, the remainder of those are now due at the usual dates, September 15th and then January 15th of the following year. Okay, I do want to take a minute to just talk about what we mean when we're talking about a business and what's different between a business and an individual. But we're talking about organizations that file these kinds of tax returns. An 1120, which is for a C corporation, and 2019 1120s are due July 15th. The 1120S is for an S corporation.
It's almost gray because it's the Preston Newcastle.
And I'm sorry. Richard, would you be kind enough to mute
I'm
your...
trying to figure out how to turn off the mic.
Okay. Well, it
I'm
kind of
sorry.
startled me when I heard somebody. No, you're fine. I know sometimes it's difficult to find the right way to throw the switch, so I understand. And to answer Susan Davis's question, I can provide a copy of the PowerPoint by email later on. There'll also be an opportunity to review this video once I get it posted up on YouTube. I had hoped to have it done by this evening, but I won't promise. I definitely will have them done by the weekend. I do want to make a comment though about the 1120S return. It's already, unless you filed an extension to do your 1120S, it's already past the due date for the 2019 filing for Form 1120S. Also, Form 1065, which is for a partnership, is also considered a business. But as I said, it, like the 1120S, is past due unless you file an extension. Other kinds of businesses would be people that have to file a Schedule C, which would be a sole proprietorship, and it attaches to your Form 1040. And of course, those are due on July 15th. And then also, it's possible that if you are running a real estate business, you may be filing a Schedule E, which is rental property and some other income like rents and royalties are the primary purpose. On the back of Schedule E, we have reports from pass-through entities like partnerships and S-corps. Also amounts from trusts and other kinds of things. But the issue with the Schedule E is this. Based upon the definition of a business, it's possible that you could have rental properties and be getting rental property income and still not have a rental property business. So simply be aware of that, and that's something that you want to talk about with your tax preparer. And if you do qualify as a business, then that's good, but it isn't necessarily so. Okay, the biggest thing that has impacted businesses in this, from the CARES Act primarily, has been the issue of what to do with employees. When the government decided to increasingly lock down sections of the country, and by increasingly I mean when it was first brought up, it was simply something that they were suggesting that you do. But finally, the suggestions got even stronger until they were using executive orders to shut down businesses, non-essential businesses, and so forth. And so when that started to happen, the problem of what to do with employees who were being laid off for an indeterminate period became very necessary. And what we first saw happen was a couple programs that were attempting to protect the income of employees and allowing employers who were willing to let the employee continue to be paid, allowing the employers to do that through manipulation of the employment taxes, which every employer pays through their 941s. This is one of President Trump's favorite tools for dealing with these kinds of situations. But it was very obvious shortly thereafter that this was not enough. And so that's when they started to liberalize the unemployment laws, that the federal government decided to kick in their extra $600 a week unemployment payment on top of whatever the states paid. Don't forget that when you get unemployment from a state, it's based on just a percentage of what your wages are. They don't pay you back 100% of what you may have been making, although there is some higher payments for people who make more money, as demonstrated by the reports that have been filed on those people in the past. So that was the next stage of the response to the shutdown of the economy. And then finally, we get the CARES Act, which brought about the PPP, Payroll or Paycheck Protection Program, whichever you want to call it. There was also a smaller program already in effect called EIDL, the Emergency Injury Disaster Loan System, which was administered 100% by the SBA. When it first was announced, it wasn't tied to the issue of employees or employment. It was intended to be reimbursement for operating costs, was the phrase they used. That, like so many other things, has developed over the month and a half since it started. And now it is linked to the number of employees you have, or if you're self-employed. And the amount of the loan, which originally was called or was told to be up to $10,000, actually turns out to be $1,000 per working individual in your business. A little bit easier to handle, and it has changed the circumstances to a certain extent. So both of these programs are kind of running in parallel with each other. So most of what I'm going to say, while I may address it toward the PPP, as far as I can tell, applies in the same way to the EIDL with a view toward getting forgiveness, because that's the big impact of these. They're going to give you money to keep your employees and certain operating expenses paid during an 8-week period that the loan is supposed to compensate for. The idea behind both of them now is to make sure that people are still able to work, which does two things. It takes the burden off the unemployment system for those people, and it also provides an easier way to administer payroll for people, because you can keep the people that you can retain the employees that presumably you had and want to keep because you hadn't laid them off before the program started. So that's kind of the purpose of this impact. But here's the deal. What we're concerned about here is, okay, if I get forgiveness, how do I get forgiveness? And what happens if I don't? So let's look at a couple issues that we're dealing with here. This is the 8 weeks immediately following the disbursement of the PPP money to the borrower. Not 8 weeks after the date of the approval of the loan, but the 8 weeks after the money is deposited in the bank account. And then you have to begin using the funds within 10 calendar days of that, I said approval, it's from that disbursement. So if you get the money on Friday, then you have 8 weeks from that Friday to maintain the records for this project. And you have to start paying the money out within 10 calendar days, which means presumably for most people, the next payroll period. You have to end up at the end of the 8 weeks with the same number of equivalent employees as at the beginning, but they test the beginning because employment changes over time. So they test the beginning on 2 periods. First period is the number of employees that you had between February 15th and June 30th, 2019. And then the number of employees that you had between January 1st and January 29th, 2020. And so you take those two figures and individually divide them into the number of average employees you have at the end of the 8 weeks. And if that number is 1 or more, you're golden. You qualify for the full forgiveness for the payroll portion. If it's less than 1, in other words, you're pro rata, you don't have as many equivalent employees, then you have that employment portion is reduced by whatever the percentage of that reduction is. The next thing is that the total amount that you pay in wages for that 8-week period has to be at least 75% of what those same employees were paid during the prior period, in the most recent quarter in which they were employed. And this comparison is made on an individual employee basis. So if Joe Blow was making $50,000 a year prior to the 8-week period, and then he has to make at least, I shouldn't use 50,000, that's too hard to figure out, 25, 35. Then he has to be making at least $37.50 at a rate of $37.50 during the 8 weeks. Otherwise, he doesn't qualify. And so that goes on to all the employees that you have during this period. Now, the way you have to apply for and ask for this forgiveness is up to your lender. And so I'm sure they'll provide you with the necessary documentation. Question is coming in that the head count, anyone paid in each of the periods, not just those paid every payroll, each of those periods. No, it's based upon an 8-week block, and dependent upon some other things we'll talk about here in a minute, as long as the number of employees on average is equivalent and the job that that person has is equivalent, then you should be able to qualify for the continued forgiveness. And you'll notice I use the word should, because I just read an article this morning about this very issue. And so I know that there's new things coming out, because one of the things this new article talked about was, what do you do about employees that don't want to come back to work? And so how do you compare them? And basically what you do is, well, we'll talk about that in a minute. So hold that thought. There are provisions in both of these programs that will also count a self-employed person as eligible for that forgiveness. And for a self-employed person, since by its very definition, you don't draw a salary as a self-employed person, then the test here is 8 weeks of net profit in 2019. So you take your net profit for 2019 and divvy it up, what is it, 50 seconds of it, and that's what your net profit would be for calculation of the payroll. So the amount of money that you receive has to be used for an equivalent of 75% of that 8-week net profit test from 2019. You also, another thing, the other 25% of both of these programs can be used to pay utilities, mortgage interest on the business building, and rent. So if you're self-employed and you operate out of an office that you rent, then your home mortgage interest does not count as part of that. If, on the other hand, you report a home office deduction on your Schedule C for 2019, then you can use the home mortgage portion to count towards your forgiveness as a self-employed person. The other thing you want to remember is that this calculation is based upon 2019, not 2020. So if you were renting an office in 2019, that's the number you have to compare to. Even though you may have moved into a home office in 2020, that doesn't count. So you can't manipulate the two by saying, okay, I'll take this one amount because it's higher. It depends upon what your circumstances were at the time. And this is something that you want to, that we'll talk about again, but you also want to keep in mind. Many of these rules have come up and they relate to things that happened in 2020, but on the other hand, they go back to 2019 for some of the calculations that are used to decide whether certain things happen or not. If you were with me yesterday, or if you get a chance to view the individual tax thing in COVID-19, that was very important when we discussed the issue of the stimulus payments and how much you got and what they were based on. We're going to talk a little bit about unemployment issues here. The employees who have been on your payroll must be given the opportunity to be rehired. Now, the reason I'm bringing this up here is this addresses the question that we got earlier about keeping tabs on everybody. Because you see, if you have somebody that doesn't want to come back to work when you've offered them their job back, then how do you use that in the calculation for forgiveness? And these are the terms which must be satisfied. And this is brand new. This is like a week old. I just discovered this. You have to give the employee an offer in writing, and it must be for the same job, same wage, same hours that they had before they were laid off. And if they reject you, then you must have documentation of that, by which I would assume as an employer that somewhere on that written offer, there must be a line that says, I accept or I refuse. And if you document it in that fashion, and everything I read used the word may, so I'm going to use the word may. You may be able to exclude this person when calculating forgiveness. But the other big may here is it's also possible that if they refuse the job, it may cut off their eligibility for unemployment benefits at that time. So it does protect you as an employer, and hopefully the people that you want to bring back are the people that you want to have back. We've had discussions at various meetings that I've been in about what do you do when unemployment is so high, the unemployment payments are so high, because you get the regular state amount plus the extra $600. While those amounts are high, people might not want to come back to work. They might not want to risk the opportunity, the possibility of getting COVID themselves. And certainly if they can not work and get more money, then that would be a good thing. Of course, it doesn't even address the issue of what's the end point of this? When does the federal government's extra $600 stop? I mean, is it continual? If somebody got unemployed because of COVID-19, but either can't, but then can't go back to work because their business doesn't reopen or a variety of other reasons, when do you stop paying that extra $600 or receiving that extra $600? So these are some issues that are still up in the air and will continue to be so for some time to come. But to specifically answer the question about how the head count goes, this is one of the ways that you can offset a head count change, but it also indicates the complexity that is being installed in the system that was already very complex. You know, one of the reasons it's that when they announced that self-employed people could get unemployment, it took all of the states weeks to be able to get that system installed because it was so different from the system that they already had. And so we had the same kind of situation here. Because of the complexities there, people got delays. Because of the complexities on the other end, I'm not sure how it's going to play out for business owners, but you know, what's the phrase they all use? We're all in this together. One of the things that you need to remember, though, is the cost that you have of unemployment. The extraordinary number of unemployed people will increase the amount that's paid from the trust funds of all the states. And even in Indiana, in the economic crisis of 2008, Indiana borrowed money from the federal government to cover the expenses for the increased unemployment at that time. This crisis is larger by far. And while I've heard on press conferences that the director of the Department of Workforce Development feels very comfortable that Indiana has sufficient money in its trust fund for the time being, how long will that time being last? And if they have to turn around and start borrowing money from the federal government again, then that will have to be paid off. In 2008, when that happened, the next year, there was a surcharge added to the unemployment contribution that every employer had to pay, and that surcharge, of course, was to reimburse the federal government. It's not been much more than a year, maybe two at the outside, that Indiana finally paid off that debt to the federal government, and that contribution surcharge was dropped. But if they have to borrow it again, that will come back. But there's another issue, and that is that because these people have been drawing unemployment, the experience that the Department of Workforce Development uses to calculate your unemployment percentage will get worse. I don't know if you know it, most of you may know it, maybe you don't, but here's how it works. Every 3 years, I mean, they use a 3-year rolling average of the unemployment payments that every employer pays out. There's a base rate, which starts out at 2.5% of the first $9,000 of any employee's income. But if you have a higher amount of unemployment payments, then that 2.5% can become a higher number. I've worked with employers in the past that have had as high as a 7% rate on their unemployment. The other issue is that if you have an extremely good unemployment rate, you can actually have a reduction in your unemployment percentage. But the point is that this is a 3-year running average. And so every year in, I believe it's July, the Department of Workforce Development tests each employer and they assign the rate for the next year based on that. Well, you don't suppose that July of 2020 won't have a much higher payment rate for almost every employer. And that will have to work its way through the system. And if the economic downturn continues for a longer period, and let's be honest with each other, it's appearing that the length of this downturn is going to be greater than we thought it might be at the beginning, then that's going to extend those higher unemployment costs going forward. So just be aware that these costs are something that you're going to have to do some planning for, maybe paying a little bit more attention to, particularly if you're an employer that has had good unemployment experience and you're only paying the 2.5% base rate or maybe something lower. Also remember that if they do have to go to a surcharge to repay the federal government, that surcharge will not be impacted by your experience. It will just be a flat surcharge that you'll pay no matter how good your individual company experience is. Why did that go away? That wasn't supposed to go away. There we go, it's back now. Okay, now we spent a few minutes talking about the forgiveness of the PPP and the EIDL. Let's talk about what that means from an accounting standpoint. What that means is this: you cannot claim as a deductible expense on your 2020 tax return anything that you paid in association with the forgiven funds. Let me repeat that. You cannot take as a tax deduction any business expense that you paid in association with the forgiven funds. So 44 weeks of your 2020 payroll is deductible, but the 8 weeks you got the PPP are not. And that's ditto for any other forgiven amounts, like a part of the rent, part of the utilities, part of those things that you paid for with funds that you got from a PPP or an EIDL that then turns out to be forgiven. The whole purpose behind that is fairly obvious, although if you want to take a nap, you can read the opinion that came from the IRS on why it shouldn't be that way. But the obvious reason is this: if you're getting the money and not having to count it as income, which if it's forgiven, you're not. So if it's not counted as income, then how can it be deducted? Because that would be double dipping. You'd get no income cost and you'd get an additional cost for the deduction of the expenses. This has some other issues as well. But one of the things that you have to be sure about is that you document both the use of the funds and the source of the funds. And what happens if not all the funds are forgiven and the balance is handled as a loan payback? And this is a provision in both programs. To my knowledge, other than having to pay interest and pay the loan back, there is no penalty for, say, turning around and not allowing the money to be forgiven. So let's look at this. You get $10,000 in a PPP. $7,500 would be your payroll equivalency. But let's look at the fact that maybe you only pay back $5,000 in payroll. So now you have $2,500 that you've spent that was not allowed to be forgiven. What happens to that? Well, it's a loan and you have to pay it back. When you sign the application, sign the documents that authorize the loan, you're told what the percentage rate will be if you don't pay it back. You'll be told what the SBA fees will be if you don't pay it back. And you'll be told what the terms of the loan are. So it's just handled like a business loan at that point. And while obviously the purpose of the whole thing was to be sure that individuals or businesses would keep individuals on the payroll, if hard pressed enough, I could see me as a business owner saying, well, I'm going to go ahead and bite the bullet and pay the part I don't use for that back as a loan and go on down the road improving the quality of my business. Oops, I'm on the wrong screen. Excuse me. There we go. However, what that does mean then is just like any other business loan that you might have gotten, the costs that are associated with that unforgiven portion of the PPP are treated just like any other business loan. You have a liability for the remainder of the loan. You pay interest, which is deductible as an expense. And the expenses that you paid as with the money that you used out of the unforgiven portion are simply business expenses as always. Which I just said, okay. One thing I will mention, if any of you have gotten a PPP or an EIDL, I guess I should say this, I have not heard yet that all of the funds have been distributed. I think it's quite likely that if they have not been, they shortly will be. But I also think it's quite likely that after Congress gets back in session and the Republicans and Democrats stop acting like Republicans and Democrats again, I really do suspect if the situation continues that there will be a third installment of funds available for these programs. Programs might be modified a little bit. There might be odds and ends that are a little different, but I really think that these will happen. So even if you have not gotten one of these loans, it's possible that you may decide in the future to do so. So if you have gotten the money, you should have put it in a separate bank account. If you do get the money, definitely put it in a separate bank account. It makes it much easier to be able to prove how the funds flowed, how the funds that you received in the program flowed through your business. Now, that doesn't mean that you have to turn around and start paying your payroll out of that account, but when you have your payroll run like you normally do, there's a dollar amount there that comes out of your payroll bank account. So you simply need to show that from your PPP bank account, you've transferred the appropriate amount of funds to match that expenditure for the payroll. It's the matching that's important, and the ability to be able to show, to trace that matching through your books. There are some questions, however, about this very issue of the forgiveness of these expenses. How will that impact the qualified business income deduction? And for those of you that are in partnerships or S corps, sole proprietors, all of the so-called pass-through income earners from your business, the qualified business income deduction is important. Well, one of the tests that can limit the qualified business income deduction is what your other payroll is. So we don't have guidance yet on whether the forgiven amount must be taken out of the payroll that's used to qualify for the qualified business income deduction, or exactly what that will come. Then we also have the fact that despite the tax treatment of the PPP loan, it is in all other regards just a loan. Just like if you tap into your line of credit, or if you go out and get a business loan for a specific process, it's just a loan. And so as it goes through your books, the loan's a liability, the interest is an expense, and the things that you pay for with the loan are simply expenses. And that has an effect on your bottom line, which then has an effect on your equity in the business. And no matter what kind of business entity it is, that equity number is very important in determining whether distributions can be made, whether partners or small shareholders, shareholders that have more than 5% of the business can take withdrawals from the business. All of those things are very important. So we're not sure if there's going to be any guidance coming from this area as well. Fortunately, we have until next January to deal with these issues. A couple things then for those of you that might be involved in property businesses. I mentioned this yesterday, but this is really a big deal. The Tax Cuts and Jobs Act made a couple changes that people didn't like. One was the removal of improvement property depreciation from the 15-year depreciation period and throwing it into the normal 29.5-year or 37.5-year period, depending what kind of building it was. There's also an issue of limitations on business loans that the TCJA imposed. In both cases, the CARES Act has provided relief for those limitations, and for the improvement property, that relief is for 3 years. It's for the years 2018, which makes it retroactive, for the year 2019, which is the current tax returns that are being filed, and for the year 2020. No, I'm sorry, I said that wrong. I'm jumping ahead to the next topic. Please forgive me. The TCJA, or the improvement property deduction, that is retroactive to 2018. But that's what it is. It's retroactive to 2018. So you might want to, if you are involved in a property business, you might want to take a look and see whether you had enough of that kind of depreciation to make it worth your while to refile that tax return. Now we get to the thing that I was trying to conflate with that other issue, and that's the net operating loss question. If you're a business and if you have a net operating loss, it may apply in the case of an individual because of a pass-through business, or it may apply to a C corporation. But if you have a loss, a net operating loss, the Tax Cuts and Jobs Act made it obligatory that you treat that loss as a carry forward, which means that the loss that you can't use gets carried forward to be applied to taxable income for a future year. The CARES Act did make that, put it back into the old system for the 3 years, 2018, 19, and 20. And the old system was this: you had a choice of whether or not to carry forward or carry back that loss. Now, the advantage to carrying back is this, and this is probably the reason they put it in the law. If you carry back to a previous year, and under the CARES Act, you can go back to the 5 years prior to whatever year you had the loss. If you have paid taxes for one of those 5 years, then you get to reduce the tax bill, which means you would get a refund for the amount that the bill was reduced, and that refund would be payable now instead of in some future year. So it may be a technical way of doing so, but the intent of this was clearly to provide another source of funds for businesses if they had a net operating loss, rather than having to wait for it in the future. It still requires a certain amount of planning, however. If the amount of money is not large, or if you have other resources that don't require you to tap into this rather esoteric way of getting money back, you're probably smarter not to use it for a couple reasons. One, there's the expense of having to do an amended tax return. Two, there's the fact that I really couldn't say when you might actually get that refund money, for the very simple fact that the IRS offices are shut down for the most part, and even those that are operating on a short schedule, and they aren't even going to begin looking at amended tax returns until this tax season is over. And then generally it takes 6 to 8 weeks after that before they start getting results for those amendments. So there is the time issue. Second thing is the amount of money that you might be able to carry forward in the year 2020 because of the economic difficulties that we've had this year may mean that it makes more sense to offset what will likely be an improved 2021 by having some net operating losses to carry forward there. But the thing I want to caution you about, whatever you do with your planning on this topic, is this. Because of the way this was done for 2019 and for 2020, if you have a net operating loss, you do need to make the election on how to handle it. I've seen nothing that says that you have to go back and amend your tax return for 2018, but traditionally, if you decided to make a net operating loss carryback election, you did have to file an amendment just for that purpose. So I will look into that a little bit more, but it is something you want to be aware of that could make a difference for your tax situation. And this next slide just talks about all the stuff I just talked about, so we'll go on through that. Self-employed people. Okay, we'll get back to that head count question in just a minute. One thing that the CARES Act has done will impact those of you who are self-employed because you pay self-employment tax. That's always one of the reasons that we try to get people to file their self-employment situation as though they were a corporation to avoid some of the self-employment tax. But if you have self-employment tax, this new provision is a good one. You can't use it if you've taken advantage of a PPP loan forgiveness. Let me repeat that. You can't use what I'm about to talk about if you've taken advantage of PPP loan forgiveness. But if you haven't, and you still owe self-employment tax on your 2020 tax return, you can pay only 50% of it at the time you file the return, and then you get to pay 25% of the remainder before December 31st of 2021, and then the final 25% before December 31st of 2022. So that essentially gives you 3 years to pay your self-employment tax for the year 2020. Now, these provisions are standalone. This, unless Congress changes it, this does not go back to 2021, back into effect in 2021. The original rules that you do have to pay your self-employment tax come about then. but it can be a boost for people who are self-employed. And I must admit, I got excited when this first came out. It looked like we were going to be able to use that for 2019, but it's been made clear in several of the publications that this did not go into effect until the CARES Act was signed, which meant that it could not apply to 2019 tax returns. Okay, well, let's go back and let's leave that there for right now. I've gotten a couple questions regarding the issue of the head count situation. When the reason that they did that with two forms, let me go back and see if I can't get back to that particular page a little quicker. No, I can't. I've got too many formulas working here all at once. Oh, that's great. I just made the whole thing go away. Okay, we just lost the PowerPoint, so you're stuck with looking at me for a while. There were two periods that were mentioned there that you have to compare the 8 weeks to. The 8 weeks is pretty, let me stop the sharing here. Let me get myself back on here. Okay. The 8 weeks that you were comparing with is the 8 weeks that, I guess all we're going to see is Richard Anderson. Hello, Richard. I'm sorry, sometimes this thing just bumfuzzles me because it doesn't work like logic would tell me it should. Okay. The first number that you have to get is the average number of employees during the 8 weeks from the date you receive the funds forward. Then you take the next thing that you need to look at is the average number of employees for the period from, shoot, I gotta get that back. Bear with me just a minute so I can pull that thing back up. I don't know why I made it go away completely. That was very foolish of me. There we go. Hang on, it's coming. There we go. Are we, I hope, looking at the loan forgiveness screen now, I trust. Okay, I've lost my chat, so. Okay, so you have to compare that with the period from February 15th to June 30, 2019. So that's a test period for a year ago. And then you have to use the period from January 1st to February 29th as your more recent test period. So what they're attempting to compare here is the issue of the fact that, yes, a business could have some changes from one period to the next. You'll also notice that the February 15th to June 30th, 2019 period is the so-called the test period for the COVID-19 situation. In most cases, we've continued to use that as the period that we test with. The earlier period, and you'll notice it's before, almost all before the period of February, is to test what happened just prior to the COVID situation starting to shut down. So what they want to test both of those periods for is to get a comparison as to how your business normally operates. And that's the reason why when you do this calculation, you get to choose the higher number. So if the number of employees you had in the earlier period makes your ratio with the 8-week test employee figure below 1, that means you wouldn't qualify for any forgiveness or a pro rata of the forgiveness. But your January 1st to February 29th, 2020 period does put you over 1 or higher. That would imply that your business is doing better now than it was then. So because of that, then you should be able to get the advantage of that better service when you're getting loan forgiveness. So does that answer your question better? Okay. Okay, I'm sorry, I've lost my chat thing. Oh, there, it's back. Okay. Very good. Yeah, well, I can't do numbers for everybody here today, but I can do numbers for everybody that wants to get together with me later. So, okay, we got about 5 minutes before our hour is up. Does anybody have any questions, anything else they'd like to bring up at this point? Thanks for joining us. If you found this program useful, please subscribe to our YouTube channel.